So I can see the rush to gold as wars, and it's kind of just accelerating. And that's part of the reason I'm bullish gold. I think gold's just a matter of time. It's hovering above this $2,000 an ounce level and might kind of dip below, but I think it's just a matter of time it gets a catalyst to go to $3,000. Now I'm tilting over to my outlook for gold. Going with the hypotheticals of what could happen to me are, well, they're not going for silver. Central banks aren't buying silver; they're buying gold,
Yeah.
and all the implications to me are very bullish. But silver's got a nice little unique space. It's just consolidating between this $21 and $26 per ounce level, and bias is typically upside from that. But who knows where it's going to go first? But the fundamental drivers to me are quite negative on a global macro basis.
Gold prices are rising during the European session, reaching around $2,030 as the appeal for safe haven assets strengthens amidst the deepening conflict in the Middle East. According to Mike McGlone, senior commodity strategist at Bloomberg Intelligence, the current price of gold, hovering around $2,000 per ounce, may experience a slight dip. Still, he believes it's only a matter before it reaches $3,000. McGlone emphasizes that central banks, among the wealthiest entities globally, are actively increasing their gold reserves. This trend is gaining momentum, driven by geopolitical tensions, particularly involving significant players such as China and Russia. Gold buying remained robust throughout 2023, and preliminary figures from the World Gold Council suggest that central banks are on track for another significant year of gold acquisitions following a record-setting 2022. The World Gold Council identifies two primary motivations behind central bank gold buying: its historical performance as a safe haven asset during times of crisis, and its role as a long-term store of value. McGlone suggests that gold's recent performance aligns with its role as a hedge against potential economic risks, particularly in a market reversion or downturn. The gold market is consolidating within a narrow range as investors assess the timing of potential interest rate cuts by the Federal Reserve in the coming year. Analysts are cautious, anticipating a breakout from this consolidation later, as economic data offers limited clarity on U.S. monetary policy. Will gold's role as a safe haven asset and a hedge against economic risks maintain its momentum? Join us as we delve into insights shared by Mike McGlone. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Everything's possible. Having tokens that track gold via blockchain and cryptology makes complete sense. I mean, some of them already exist. There's crypto dollars. That's basically just tokens that track it out. The bottom line for gold is the deepest pockets on the planet. Central banks are buying gold, and you have to just expect that to go away. I think it's just accelerating. There's a good reason for that. We know the two prime suspects are China and Russia. Could say some of those former Soviet Union states, but there's a good reason for that. I mean, there's a pretty significant war going on. It was somewhat instigated by one person, Mr. Putin, with support from another person, Mr. Z, and there was $300 billion of Russian assets that were seized. I mean, that's kind of upsetting for some other people like that. So I can see the rush to gold as wars, and it's kind of just accelerating. And that's part of the reason I'm bullish gold. I think gold's just a matter of time. It's hovering above this $2,000 an ounce level and might kind of dip below, but I think it's just a matter of time it gets a catalyst to go to $3,000. Now I'm tilting over to my outlook for gold. Going with the hypotheticals of what could happen to me are, well, they're not going for silver. Central banks aren't buying silver; they're buying gold, and all the implications to me are very bullish. So let me give you my macro on that. I think the big difference from this time last year is the sentiment has completely shifted from people expected a recession to U.S. Now they don't, and they expect a soft landing, which means the risk is we just tilt back a little bit. And you mentioned that early on. The Fed is pushing back a little bit on all these eases that are priced in the market. And that's another thing that's somewhat silly. So I think it's silly right now. The market basically is expecting about 12% increase in earnings this year for the S&P 500. The volatility, the VIX volatility index, if you just take it minus the T-bill rate, it's the lowest since 2007. Just look at a 12-week basis. So volatility is always reverting. It's very low. Volatility only goes up from those levels. It could stay low for longer. And the market's priced in right now, as we speak on the 18th, priced for about 160 basis points of easing in the next year, which is just silly.
Right.
It's just, I mean, the Fed has said they're not going to do that. But the thing he's got to ask yourself is what's going to take them for to ease that much? And I think it's going to take just a little bit of reversion of the massive pump in risk assets from last year. To me, gold's sniffing that out more appropriately. So if you look at 50-week moving averages, gold is at all-time new high. Just like annual measures, Bitcoin's much lower, stock market's much lower. Yes, they're bumping up near highs. But I look at it right now as just look at the iterations of this year. Do you really think we're going to be able to take this market and keep it rallying like this? Or what's the risk of just little reversion? And the dominoes trickle down. So that's my base case this year is that we follow the path of Europe, which is essentially in recession. Certainly, if you look at Germany, we follow the typical historical effects of the most significant rate hike effects in history. And that will be towards a recession in the U.S. Yes, I've been early, but it's just a matter of time. And then China continues to mean revert its massive growth of the last 30 years. It's akin to Japan when it peaked and Soviet Union when it peaked about 30 years ago. And the key question I ask myself is what stops that? Now, that is the clear trajectory you're seeing commodities right now. Virtually all commodities have been declining significantly from those peaks from 2022, and they're still going lower. Just corn recently reached the 3-year low. Crude oil keeps getting hammered. Copper's still under pressure. And gold's the only one going up. That's a recessionary trajectory from commodities. And I don't see a lot to stop it. I think the risks are it accelerates by the time we get to the end of this year.
Silver experienced a slight retreat during Friday's trading session, but swiftly rebounded, indicating signs of renewed strength. The market finds support around the $22.50 level, with potential reinforcement extending to $22, as market analysts observe. Mike McGlone, a senior commodity strategist at Bloomberg Intelligence, notes that silver occupies a unique position, consolidating within the $21 to $26 per ounce range. Despite the recent pullback, there's a leaning towards potential upside, suggesting a resilient market sentiment. The current price of silver reflects this resilience, recovering to approximately $22.70. The recovery is partly attributed to the US dollar index, struggling to extend its rebound and ongoing tensions in the Middle East, which continue to drive investor flows towards safe haven assets. However, McGlone expresses bearish sentiments towards copper and industrial metals, emphasizing a less optimistic outlook for these commodities. The contrasting dynamics between silver and other metals underscore the nuanced nature of the current market conditions. Let's get back to the interview.
There's nothing even close to the dollar in terms of fiat currencies. If the U.S. just gets a little bit of their fiscal order in place, that would be so helpful, and that might happen in the election. I'm hearing it's becoming very high in the polls that U.S. citizens are being unhappy with the inflation created by the massive monetary pump in that related. So I look at it as dollar stalwart, the U.S. is stalwart. One thing the Federal Reserve just proved how interlinked global economies are. The Fed just tweaks a little bit. Every other currency in the planet, every other central bank in the world has to tweak to keep up the buck. I mean, the Chinese yuan is pegged to the dollar. The Hong Kong currency is pegged to the dollar. Why? Because there's nothing better and not even close. And so I'm on a bit of a rant, but I do enjoy when people point out some things. Well, you talk about the petrodollar. Let's look at maybe Henry Kissinger helped get that started, that whole concept of the petrodollar. But right now, the U.S. and Canada together produce have an excess of liquid fuel and crude oil production of about 6 million barrels a day, which is about equal to that rising OPEC surplus. They have to cut back their supply to make up for the excess supply coming out of the U.S. And you know why it's happening? 2 key reasons. Number one, technology. U.S. and Canada just adopted the technology. And more recently, as the farmers say, the high price cure. So those of us who are early and eventually became right about the price of crude oil going down, I pointed out why. The world has changed. So for instance, when we talk about OPEC supply cuts, who does that hurt? China and Europe. Not so much Europe, but China. And China is the economy that's the most fragile, I think, that's really starting to just do a normal reversion of way overdue for emerging markets. I probably should stall there. There's a lot I can dig into on these subjects, but we've studied the lessons of history, which I've really been doing. I've been kicking in line a lot more history lately because it's that kind of time. We're in the back end of a significant liquidity boom and we're busting. And that's what I see why it's going to continue to support gold. Silver too, but it's probably going to be bad for copper. Well, the main commodity that remained bullish is gold. More concerned about virtually most other commodities, which are most of them are in downward trajectories. If you look at the Bloomberg Commodity Index, energy sector, industrial metal sectors, copper. There's certainly, most notably grains, because they have this shortest supply elasticity factor. Silver to me is a little bit more in the middle. I'm bearish on copper and industrial metals, and silver is more in that slant. But silver's got a nice little unique space. It's just consolidating between this 21 and $26 per ounce level, and bias is typically upside from that. But who knows where it's going to go first. But the fundamental drivers to me are quite negative on a global macro basis, which to me is the base for everything. And I can get into that a little bit, and then I trickle down from that view.
Until the first interest rate cut is implemented, the market may at times get ahead of itself, potentially elevating rate cut expectations to levels that make prices susceptible to a correction, stated Ole Hansen, head of commodity strategy at Saxo Bank. What are your sentiments on gold and silver? Are you leaning towards a bullish or bearish outlook? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.